Investment appraisal is one of the most important segments for any company. Basically, companies take two types of decisions: short-term decisions, long-term decisions. Short-term decisions are to be executed within short period of time or immediately, and results will be generated immediately. Normally, results are to be realized for the current financial year only. Comparatively, large amount of money have to be spent when executing the long-term decisions. Results of long-term decisions will be generated for several years. Those are not limited to the current financial year. For example, projects may run for 2 years or 3 years or 5 years or can be 10 plus years. In this video, we will explain you about long-term decision-making process, where we discuss investment appraisal techniques at your workplace. Different names are used for the same subject. You may hear CapEx evaluation, capital budgeting, project evaluation, but all are same and you can use the same techniques explained in this video. Let's look at a few examples before moving further. Putting up a new manufacturing plant, purchasing a new machine, constructing an internal warehouse instead of outsourced warehouse, purchasing a new fleet of vehicles for distribution, expansion of the existing production line. If you carefully look at, you can see that all these have some common features such as involve long-term nature, large amount of money have to be spent, create value to the company, or increase the profits of the company over several years. Here, companies need to look at mainly two aspects of feasibility studies when making long-term decisions: technical feasibility of the project, financial feasibility of the project. As the finance professional, you will be asked by your CEO to advise on these decisions. So you can mainly use below techniques for assessing these financial feasibility of these projects. Payback period. This can be simple payback or discounted payback. Net present value or NPV. Internal rate of return or IRR. Before discussing these techniques, you need to know two basic concepts. First is the present value of money. I will ask a question from you. Person A will say he will give you $1,000 today. Person B will say he will give you $1,000 in 5 years' time. Which one will you prefer most? The money you get today or after 5 years? Exactly. You will prefer to get the money today rather than waiting for 5 years. The base for this decision is the time value of money. Value of money is linked to the timeline. This is because of two things. First, inflation. Inflation is the increase of prices of goods and services over the period of time. Inflation reduces your purchasing power. When prices are increased, you cannot afford the same quantity of goods for a given sum of money. Second concept is cost of capital or opportunity cost. That is the investment income that you can earn from the money you invested. So opportunity cost is the cost of capital you invested. We call it as the discounting factor, and normally it expressed as a percentage term. Now you will understand that cash flow in each year will not be the same. So you have to convert cash flows in different years to a comparable basis. That's where we use the present value formula. You can see that present value equal future value divided by 1 plus r to the power n. R is the discounting factor. N is the number of periods. We will see later how to apply this formula using our example. Now you know the two compulsory concepts of present value of money and cost of capital. Let's now look at the techniques to be used in our investment appraisal. Most common approach is the NPV and discounted payback period. Payback period is how long will it take to recover the investment. For example, let's assume we invest $1,000 today and you will earn $500 in year 1 and another $500 in year 2. So here your investment amount can be recovered in 2 years, which means the payback period is 2 years. This payback period can be expressed as simple payback and discounted payback. If you use the undiscounted cash flow, then you get the simple payback like in our example. But if you use the discounted cash flow, then you will get the discounted payback period of the project. NPV is net present value of all future cash flows, both inflows and outflows. Positive NPV means project is generating more value than its cost. It is increasing the wealth of the shareholders and project is profitable. Negative NPV means project cost is higher than its value generation. It decreases the wealth of the shareholders. Project is not profitable. Zero NPV means project is break even, that is cost equal value. So let's look at how to make the decision. Positive NPV projects should be selected for execution. Negative NPV suggests that project is not financially feasible, so not a good investment. IRR is the internal rate of return. That is the rate where NPV becomes zero, or else rate where project is break even. If the IRR is greater than the cost of capital, which means project is profitable and should be accepted. If the cost of capital is greater than IRR, which means project is not profitable and project should not be accepted. Now you have gathered sufficient knowledge about the concepts and techniques. So now let's look at the approach you should follow to perform the financial evaluation for the given project. First thing you should do is to understand the business case very carefully and gather below information from the supporting departments. First, capital expenditure estimate. This is the amount of money you put in today for the project. Engineering department can assist you in providing the estimate if this is a construction related project, for example. Then understand and determine what are the financial benefits company gains by executing this project. Here you need to understand the cash inflows and cash outflows of the entire project period. Cash inflows are the incremental revenue or incremental cost savings. Cash outflows are the incremental expenses to be incurred. For example, the operation cost. Once you gather above basic information, you can put this information into a financial evaluation model. Now let's look at how to do our financial evaluation model. So just open up a new Excel file. So there we will type like start from the years into the columns. So start from year 0. So year 0 is the current moment or the current financial year. So then the number of years that you want to evaluate for this period or the useful life of this period. So you can type into the columns. And so let's say we are going to evaluate for 5 years in this project. So in the rows, you can mention the cash flows. So first we will mention the investment amount for this project. So I will just quickly format this area. So in this example, let's assume we invest $10,000 today. So in the next row, you can mention the cash inflows. For this example, let's assume it is $5,000 each for up to 5 years. Next row, you can mention the cash outflows. In this example, let's say it's $1,000 per year. So just put it as minus. So then you will get the net cash flows. So you can just get the summation of these two plus and minus figures So it will be around 4,000. So remember, here we have mentioned the incremental cash flows, incremental cash inflows, incremental cash outflows. Here we have not taken the non-cash items also. So remember that here we consider only the cash flows, not the non-cash items like accruals. Once you have the net cash flows, then you can calculate the tax amount that you have to pay. So for example, in this, we'll take as 20%. So just put minus the cell into the tax percentage. Let's say 20%. So this much of money you have to pay. So after that, you can take the cash flow after tax. So you can get the sum of these two cells and just copy paste the same formula. So another line you can mention the cumulative cash flows. So here you can get the each year's cash flow. Year 0 cash flow 10,000. So the cumulative cash flows is minus 10,000 plus 3,200 the year 1 cash flow, and then year 1 cumulative cash flow plus the year 2 cash flow 3,200. So likewise you can copy paste the same formula. So you can see that the cash flows become plus at the end of the fifth year. So up to now, this is the undiscounted cash flow, cumulative cash flow in this project. So after that, you will understand that, and we have discussed this topic, that the cash flows in each year is not same. So these are the cash flows of each year. But you need to understand that the cash flows, like in year 1, you get 3,200 and you get another 3,200 in year 5 also. But this 3,200 is not same as what you get in year 1. So that is what we discussed earlier of this video about the time value of money. So here we have to get the discounting factor. Discounting factor. So we'll get another column and we'll mention the discounting factor. So I think the theory part I have discussed in the earlier part of video. So this is the cost of capital of the money you invested. That means the opportunity cost or the investment income that you forward from this project. So let's assume this is 10%. So the discounting factor we consider here is 10%. So that is the cost of capital of this project. So if you can remember the formula of the future value and the present value. The present value formula that we discussed earlier. So you can mention that, so year 1, year 0 is the present moment, so you don't need to discount. So let's put it as 1. And the year 1 is, so the future cash flow, let's say 1 divided by 1 plus R. R means the discounting factor, so I will link it here, and to the power the number of the year period. So in this case it's the year 1, and so you can expand your values, so you will get 0.9091. So which means the money that you get today, in terms of the value of that money, it's only 0.90. And if you copy paste the same formula to the next columns also, so you will see that the value is getting reduced. So this means if you get $1 today, it equals to $1, but if you get it in year 1, it's 0.9, year 2, 0.82. Likewise, in year 5, what you get is 0.62. So then you can get the discounted cash flow by multiplying the each year's cash flow by this discounting factor. So this is the cash flow, undiscounted cash flow, so multiply by this discounting factor. So and copy paste same formula, so you will get the discounted cash flow in each year. So you will see that this 3200 is equal to 1987. So this is the value of this 3200 in today's term. So and another line you can get the cumulative discounted cash flow. Similarly, you can get the summation of the previous year cash flow plus this year cash flow, and you can copy paste the same formula. Okay, now you have all the information for your financial model. So let's calculate the each technique that we discussed. First, simple payback. So let's calculate simple payback. So simple payback is how many months or years will it take to recover your investment with undiscounted cash flow. So you can see that from this cumulative cash flow, so your cumulative cash flow become positive at the fourth year. So which means your you can recover your money in the fourth year. So, which means you have completed 3 years and another few months you have to spend to recover this 10,000. So, what you can do is, so you can say, okay, you have completed 3 years, so into 12 months, so that is 36 months you have already completed. Another few months you have to spend. So just open brackets and let's say minus 12. So which means in the fourth year you have 12 months and you will get another 3200 in this 12 months, but we need only 400 to recover our investment. So close brackets and you will get the answer as 38. So which means simple payback is 38 months. Similarly, you can calculate the discounted payback period. So now let's look at how to calculate discounted payback. So if you look at cumulative discounted cash flow line here, so you will see that the cash flow become positive in the fourth year again. So you have completed 3 years and fourth year you are going to recover from discounted cash flows. So let's type our formula. Number of years completed 3 into the 12 months plus open brackets and minus then 12 months for the next year. So out of this 12 months you will get another 2186, but we need only 2042. So close brackets. Okay, you get 47 months. So you can see that simple payback is 38 months and discounted payback is 47 months. Now let's calculate the net present value or the NPV. So NPV is the present value of all the cash flows in this project. So you can see that we have already calculated this figure. So if you go to this line, so this is the cumulative discounted cash flow. So and this is the individual year's cash flow and this is the cumulative. So so in the year 5 you can see that 2131. So that is the NPV amount. Or else you can just sum this all the cash flows in this project, same value. Or else you can use the NPV formula in Excel. So just type NPV like this and open brackets. Then you have to give the rate, that is the discounting rate. Then the cash flows. So here the undiscounted cash flows of this project plus the first year investment. You can see that same value you get. So lastly, we'll calculate internal rate of return or IRR. So here you can use the Excel formula IRR, just type IRR, open brackets, and then give the values, undiscounted cash flows of this project. Just close the bracket and press enter, so you will get as 18%. So what does 18% means? That is, if we use this 18% as the discounting factor, our NPV value will become 0. So for example, just equal this discounting factor to this IRR value. Yes, you can see that the NPV value becomes 0. So just undo it. So that is the IRR value of this project. So now we have calculated the essential techniques for evaluation of this project. So here is the summary of our example project evaluation. Simple payback 38 months, discounted payback 47 months, NPV positive $2,131, IRR 18%. Decision based on payback period is subjective and it depends on management discretion. Some company can set thresholds to the payback period. For example, any project with discounted payback of 48 months or lesser can be accepted. But lower the payback period is more beneficial to the company, and such projects are more attractive. Positive NPV suggests that this project is acceptable since this increases the shareholder wealth. And higher IRR value than the cost of capital of 10% again suggests that this project is acceptable. Based on above, you can give the recommendation to a CEO whether the company should invest in this project or not. So this is how you need to conduct your financial feasibility of any capital investment project. Hope you understand the concepts and the calculation methodology which we discuss in this video. And we expect that now you can confidently apply this knowledge at your workplace. If you enjoyed this video, please give us a thumbs up and leave a comment below. Further, please subscribe our channel so that you will get notification on further videos on practical aspects of different finance related topics in coming days. Finally, thanks for watching and let's meet from our next video.